Welcome back to the Industry Leader Update. This week, as promised, we have part 2 of our exclusive interview with Dan Hultquist with Understanding Reverse. And we've just discussed the 6 Ps, well, at least the first 3, and this week we're going to go over the rest of them. Dan's going to tell us the 6 Ps that impact the health of the reverse mortgage industry. Dan, thanks again for coming back and joining us. So where we left off, we stopped on the premiums and some of the pricing, but now we have 3 other Ps to go over. Can you recap the 6 Ps before we begin?
Right. If you take a look at the 6 Ps, they are product mix, principal limits or principal limit factors, and then number 3 is premiums and pricing. Number 4 would be public perception. And that's nothing new. This has been a problem for us for decades, right? It seems like we as an industry have kind of given up in some respects. I feel like as an industry, we probably need to continue to push in those efforts to make sure that we counter the critics. Anybody that says something bad about our industry, we need to defend the industry. Don't apologize for selling the greatest retirement cash flow solution ever created. I mean, that's what I believe about the product that we sell. Be proud of it. Defend the product, defend the industry, and we probably need to create a little bit more emphasis on public perception. When anything's negative that's written about us, we need to go on the attack.
And that's so true. Just last week on a Friday, I'm a member of a social club and sat down with a very experienced realtor, and he didn't really know much about reverse mortgages. And when I told him some of the features, such as the increasing line of credit or principal limit over time and the protections, he was shocked. So I agree, we have to put it out there and get the word out to the public.
Yeah, that's a good call. Focus on the consumer protections because we know it's strong.
So Dan, what's our 5th P of the 6 Ps that impact the reverse mortgage industry's health?
Right. Number 5 is policy or policy guidelines or regulatory changes. And there were no significant policy changes for fiscal year 2022. And that's kind of a good thing, right? Because we all get a little bit scared in August and September, knowing that we're coming up on the end of the fiscal year at the end of September, and a lot of regulatory changes take effect on October 1st. And so we were a little bit relieved that there were no significant policy changes, but that doesn't mean that there aren't policies out there that are not good or policies that can be improved upon. And so the first one comes to mind is collateral risk assessment. I don't like it. Personally, that's me speaking personally. I don't like collateral risk assessment, the second appraisal policy. Some of you know it by that name. If there are appraisal issues, it needs to be addressed on the appraisal side. I don't think we should punish the client or punish the lender. And I also believe that increases the cost to the mutual mortgage insurance fund. I think you could make a case that it has actually hurt FHA's mutual mortgage insurance fund to have the collateral risk assessment.
And how is that impacted? How is that fund negatively impacted by that second appraisal or collateral or risk assessment when that's required?
Well, there's a couple of things. Number one is it's more costly to get a reverse mortgage. So initial loan balances are a little bit higher. Number 2, it reduces volume at a time when we've had high appreciation rates and low interest rates. And so since collateral risk assessment was implemented, it was well-meaning at the time, but you look back, it's easy to, Monday morning quarterback, but still you look back and realize we were at a time when we actually needed a lot more volume in the industry. It also hurts public perception. Yeah. When we have people that get a $2 million first appraisal and they have to order a second one, and in some areas of the country, that could be an extra $1,000 in costs.
Good point. And what's our last P of the 6 Ps?
Lastly would be property values. And that's actually been a bright spot in our industry for the last few years, at least. Property values have increased. We've been able to help more homeowners as a result. Retirement cash flow planning has been a reality because there's so much equity out there. Over $11 trillion in senior home equity. But we don't know how long that's going to last. We do see pockets of the country where we see some declines, and rising interest rates have kind of put a wet blanket on our home value increase party that we had for a few years.
And what a party we had. And yes, we've seen demand destruction really on the traditional mortgage side because their payments have gone up 30-40% than they had a year ago. So That's definitely going to impact home values. Do you or I know how far home values are going to adjust? I don't think we do, but we're seeing it. I mean, check your neighborhood, folks. Go on Zillow and you will see price drops. Dan, thank you again for coming and joining us, and we really appreciate the insights you provided on the 6 Ps, the 6 factors that impact the health of the reverse mortgage industry. And folks, if you have questions or comments, you can leave those in the comment section right below this video. And please share this video, if you would, with other reverse mortgage professionals, especially on LinkedIn. We want everyone to get the word and understand some of the concepts that Dan presented today. And we have a YouTube channel as well, so be sure to subscribe and hit the notification bell. That way you never miss an upcoming episode. And each and every week, we tell you every time, you can get your reverse mortgage news on the go. That is with HECM World Weekly, the nation's only weekly podcast, by the way, for reverse mortgage professionals. Apple users can listen and subscribe on iTunes. That's a wrap for us, and we look forward to seeing you next week. Until then, happy originating.